This is part one of a multi-part series on Stephen Miran's A User's Guide to Restructuring the Global Trading System. Decided to do this multi-part series to hopefully make this information more accessible. It is a 41-page document that is very dense and requires quite a bit of studied reading. However, it does seem to be the blueprint that the current administration is working from for trade policy and possibly future trade policy. So this essay is going to provide us with some tools that are available for a substantial overhaul of international trade, and we're going to want to look into that. The reason that this specific document seems relevant to this conversation is Stephen Miran wrote it in 2024, the same year that he was sought out by Besant to join the Trump administration, which he did indeed do. He has since ascended to the Fed board with some controversy surrounding that ascension, and has been talked about as the architect for Trump's trade policy by multiple publications. And so this seems to be the source of a lot of the information that the administration is working from. And so I'm hoping we can be on the same page as the administration by being more understanding of this document. So the reason that the need for a substantial overhaul exists is due to two parts, mostly. First part being that the sentiment in America has deteriorated greatly over the last decade, and so Trump and camp believe that there's been an American consensus to see real substantial change occur. Those tensions have been pressured for a couple of different reasons, but the main thing that Miran points to is the loss of the manufacturing sector. He states that the China shock period, that we'll talk a little bit more about, severely underestimated the actual losses that occurred. And so we've had a major period in time here where the majority of America doesn't feel like the system is working to their benefit, and that's been exacerbated because the way that this has worked in the American economy becoming more financialized is that the wealthy have done extremely well during that same time. The other part of this is that China and Russia have been showing persistent trade and security threats. And so the manufacturing sector being hollowed out becomes a major national security threat in the sense of if we cannot produce our own equipment, other things that Miran talks about is pharmaceuticals and a more broad sense of a manufacturing sector, we are imposing a real threat to our own national security by not having the ability to produce those types of things here at home. So from a trade perspective, Miran points to the overvaluation of the dollar as a main reason for the change in circumstance and sentiment. He believes that the woes are rooted in a persistent overvaluation of the US dollar and asymmetric trade conditions, specifically because of the weight that that's had on the American manufacturing sector while benefiting financial sectors of the economy. So like we talked about, the financial sectors doing well and the wealthy of America accelerating growth and being more prosperous during this time creates more tension and creates a relativity to where the average American feels even more left out, right? They feel as though the system is working for others and not for them. They see that the wealthy have benefit at far greater levels than anybody else, and that's leaving a very sour taste in a consensus of American voters. Now, the main area that Miran points to as the trigger, or sort of the initiation of this change of circumstance and sentiment, is the China shock, which was the period of 2000 to 2011. He points to the 600,000 to 1 million manufacturing jobs that were lost during that period as underestimating the severe consequences that actually occurred. And so the amount of job losses is substantial in a nominal sense. However, the reality of it was that once those jobs were gone, the associated jobs in those communities were gone, and entire communities were blighted versus just a few jobs here or there in different factories and etc. We had entire towns and communities that were essentially erased by this loss. And so those were a lot more substantial of consequences than just the sort of economics of the unemployment portion of that picture. And so he believes that that is why you're going to get some differing opinions from this period of time from an economist versus the average American voter. But the average American voter has come to a consensus that this system is not working for them. So how is it possible that the United States has managed to maintain such an overvalued dollar and consistently run deficits? How come it has not been able to balance out its trade or achieved an equilibrium? Because what we would expect, especially in such a large market like trade, is that eventually you'd rebalance your trade. So for example, if a country was running a surplus over a long period of time, you would expect that trade to balance out because they're selling more goods to the world than they're buying, and so they're receiving much more foreign currency than they are putting out into the world of their native currency. And when they receive that abundance of foreign currency, they're going to exchange that for their native currency, and the market dynamics are going to push their currency to a higher level, and eventually that's going to make the goods around the world relatively cheaper, and they'll start buying more from other countries, and they'll eventually move to a more balanced trade because as they're buying more, their imports will rise, and most likely their exports will decrease, and so they will achieve an equilibrium over time by those trade systems balancing out and their imports and exports moving closer and closer together. There's another way that we could achieve equilibrium that we also don't see, which would be financial equilibrium, and where currencies would eventually equilibrate due to savers selecting investment alternatives among different countries. They're going to look at the risk-reward potential, and they are going to invest in the currencies that offer those rewards. And due to the competitive nature of a worldwide market, we would expect that those currencies would adjust to make investors indifferent between holding assets denominated in different currencies, because over time, as they look at those different risk versus return options, the market would be expected to equilibrate as those investors' choices move the levels to par over time. So why is that not occurring? Well, the main reason that that's not occurring is that we have the United States dollar as the reserve asset. And so disequilibrium occurs and creates what we're going to call a new Triffin equilibrium when there is the case of a reserve status nation. This was spoken about in front of the United States Congress back in 1960 by Robert Triffin, so this is not a new concept by any means, but is extremely relevant today and is the major cause that we see the consistent deficits being run. So that leads us into the Triffin world. So instead of an optimal world where we would achieve equilibriums, we are instead in a Triffin world where financial and trade equilibriums decouple and move toward a separate deviated Triffin equilibrium where a country's currency is used as the reserve asset for global trade. The reason that this throws a wrench into the system is that the reserve asset totally messes up the demand part of the economics, in the sense that it no longer becomes the U.S. dollar is no longer operating in those trade or financial equilibriums because there's an inelastic demand for those reserve assets in order to keep the global system working. And so the United States is essentially necessitated to continue to offer the security assets, treasury securities, and the United States dollar that's not rooted in achieving any type of equilibrium. And so these reserve assets are being held for policy reasons instead of the reasons that would lead to any type of equilibrium being achieved. And what we see over the long term is that when the United States is large relative to the rest of the world, that Triffin equilibrium is not far off from the real trade or financial equilibriums. It's not going to create massive impacts on the United States so long as the United States is large compared to the rest of the world. However, when the U.S. share of GDP as a percent of the world goes down, those pains and that deviation grow. And so what we can look at is the recognition of where that trough occurs is during the global financial crisis. And so when recessions occur and the United States share of GDP goes down, then we also see an aligned pattern in manufacturing employment. And so the U.S. share of global GDP drives the size of that Triffin distortion in the trade, which in turn drives the state of the tradable sector. And so we can again, look at the comparison of those two graphs and see the correlation that's occurred. And so when the reserve nation is large relative to the rest of the world, like I said, those equilibriums aren't far enough. We don't have too much of a noticeable externality. However, when global growth starts to pass that reserve nation and the reserve nation becomes relatively smaller, then tensions build and the equilibrium decouples enough to create significant overvaluation of the reserve currency with the major economic consequences that we've talked about, especially in that manufacturing sector. This can eventually lead to a point that's called the Triffin tipping point, because the reserve nation is forced to continue to export those reserve assets in order to facilitate global growth. It becomes a basic necessity for them to continue doing that, and so they continue to receive foreign currency for doing that, and that foreign currency is then spent on imports and continues to rise, like we talked about in that surplus situation, is in this case the reserve assets become that consistent account distortion, in that we're consistently receiving more foreign currency and consistently overvaluing the United States dollar as a result of it being a reserve asset. And so therefore, as a result of the world growing, the dollar overvalues consistently more, and it incentivizes more importing, and it continues towards a tipping point. And that tipping point is where those deficits that we're running become so large that it induces credit risk in that reserve asset. And so the rest of the world becomes less confident that the sustainability of the system is going to work, and that can cause the credit risk of the concerns for the reserve asset being a sustainable and working reserve asset. And so that brings us to what's called the Triffin dilemma or the Triffin paradox, where if you're the reserve currency, it's going to eventually lead to permanent twin deficits, which are then going to lead to an unsustainable accumulation of foreign and public debt, which then eventually undermines the safety and reserve currency status. And we do not want to reach the tipping point. All economic theory points to that is a not great place to be, in the sense of global chaos and not seeing any benefit that would come from reaching that point. I think it's fair to say that some people might be a little bit fearful as we read about those things and think about our current situation and start to ponder, are we there? Are we at a point where we've already gotten to a large enough deficit to induce credit risk? But Miran wants to ease those concerns. He says we are far from a tipping point. I put far in quotations because he uses that relative term, does not give us a timeline. I don't think he could, nonetheless, but far is a relative term, so it's a little difficult to interpret what he means by that. But he gives reason as to why he believes we're far from that tipping point, and the main thing seems to be that there's not really any alternative to the United States at this point in time. And so where that comes from is there's some necessary requirements for a reserve asset. The reserve asset should be readily available. It should be highly liquid. It should be a stable store value. It cannot be a highly volatile asset that's going to lose 50% tomorrow. It needs to be easily convertible into a large range of foreign currencies. And there should be confidence that the issuer is not going to default or freeze assets, that it's a trustworthy issuer with sound macroeconomic history. And so, even looking at this part of things and the reserve asset, we could certainly look to that and think, well, the United States doesn't necessarily seem the best case scenario for that either. But the reality is that the second best, anything that we would think of as an alternative, the flaws in that are going to be to much greater degree than the United States. So although, I wouldn't say that we've got the perfect thing going here in terms of the United States being the best reserve asset that we could possibly find. At the moment, it's hard to find anything that would be available as an alternative. And so what are the consequences of being in this Triffin world and being in this situation as the reserve currency being the United States dollar? And so we've got three major consequences that we're dealing with. The Triffin world is going to create cheaper borrowing for the reserve nation status, in the sense that you would expect for the cheapest rates of borrowing, given that you have the reserve currency, and it may reduce borrowing costs. What Miran looks at is compared to the rest of the developed world. The United States certainly doesn't have the cheapest borrowing rate, and so this consequence is relatively negligible in terms of being the actual reserve nation, because there are plenty of developed countries that are able to borrow more cheaply. So it's not necessarily that enhancing and reducing any costs. However, there is a definite and very obvious difference between emerging markets and developed markets, and we can point to the reality of cheaper borrowing is definitely existing. And so although it's not necessarily getting us to the cheapest borrowing in the world and not providing as much of a reduction in cost, what it certainly does do is it leads to more borrowing without as much concern for the rising yields. And so it allows for more borrowing without as much concern for consequence when you're the reserve nation. And so although it's not necessarily reducing much of the costs of those borrowing rates, it is indeed making it a lot more easy for the United States to borrow more money. Richer currency is the second consequence, and so the demand for that reserve asset can overvalue the dollar far in excess of what it would be in a balanced trade system over the long run. This is what we've talked about already, in quite depth, so I'm not going to spend too much time on the second one. The relationship between reserve status and manufacturing is most destructive during recessions. Again, we talked about why that is. The third consequence is financial extraterritoriality, and so this is the main benefit that you get by being the reserve nation status. Whomever controls the reserve assets can exert control over others via that financial proxy of the trade system. And so what that allows is for policy and for national security to be implemented without any high cost combat or boots on the ground, because you have the ability to utilize that reserve nation status to implement foreign and security policy via finance, versus actually having to go and accomplish anything through war. So the trade-off becomes export competitiveness versus financial power projection. So the beneficial consequence is that you have financial power projection, and the negative consequence is that you lose your export competitiveness. And so as the economic burdens grow, with being the reserve nation status in a driven world, the trade-off becomes less attractive. And the reserve nation finds it harder to underwrite the global security as those deficits run higher, and that manufacturing sector gets hollowed out because it makes it much more difficult to produce the necessary equipment to back up the things that you're doing, right? And so, if you have no muster to be able to put together any real consequence of the things that you're trying to implement through your financial policy, people are going to call your bluff if you have no manufacturing ability to produce equipment. And so that becomes a major problem in the long-term driven world consequences. And so that will be the completion of our first part, and we'll move on to our second part, which will be about tariff-driven responses to redressing grievances. And so I hope this video was helpful in understanding the underlying economic causes of the imbalances that we are experiencing. And so next we're going to start to talk about some of those tools that we can use to address these things.